Hello and welcome to this very special program. On the eve of the new Samvat here, we decided to step out of our studios. It's been 2+ years of COVID, lockdowns and whatnot, and it's finally good to be out. You can see that the enthusiasm is palpable to celebrate and of course enjoy. As we enter the new Samvat here, it is also always a good time to take stock of what has happened and also to look ahead. And to help us do that, we have a very special guest today. Kenneth Andrade is my guest on the program. Kenneth needs little by way of introduction. He has been a star fund manager for 20 years, 20+ years now. He ran Money Blast at an institutional platform, which was IDFC Mutual Fund. And for the last many years, he's been running Money at Old Bridge Capital. He manages money for retail investors, high net worth individuals, institutions, both foreign and local, and many others. Assets under management now, the firm, are just under $1 billion. Kenneth, it's a pleasure. Great to have you with us here on the program. It's great to have you with us here.
Thanks, Prashant. It's great to be on the show.
Not in the studio, but outside.
Yeah, it's
How are things looking, Kenneth? I mean, you know, we are talking at a time when there is great global turmoil, great global uncertainty, but it's always about how much of it is already in the price. To your mind, how much is in the price?
Valuations seem to be almost there. You might give or take another 5% or 10% from there. Remember, it's a matter of time, not a matter of price.
Okay. You mean time correction rather than significant price correction?
Yes. The rhetoric we hear today is recession. We'll have to see what comes out after recession. So we know what's going on in the world economy. The world economy is shutting down for winter. For the simple reason that energy prices are too high, it's getting diverted, there's demand collapse. Demand collapse leads to deflation, okay? And it's quite opposite to the inflationary scenario that we've seen in the past. So
right.
Once you get deflation off, I sense on the other side, interest rates will be more manageable, and the world economy will go back again. So look at it on the other side.
Which is how long? 6 months out?
Post-winter.
Post-winter.
The post-winter is coming
post-winter, prices will be down, the inflation problem would have been tamed. And then you have to look at how policymakers react to that situation. That's what you're saying?
Yes.
So the printing, I mean, starts again, support from policymakers, etc.?
Let's not look at it in such a narrow framework, right? Now let's see what happens on the other side of the world. So Europe is closing down. That's almost 20% of the world economy. When Europe comes out, and the normal noise or normal commentary that I hear is that a lot of European manufacturing is moving out of Europe, right? The problem remains it's an energy problem for Europe. Look, on the other side of winter, they come out with one of the weakest currencies that they've ever had in one of the most industrialized nations that we've ever seen.
Sure.
Okay, and that's going to kickstart a lot of institutions getting back, manufacturing back again, etc.
In Europe? Possible?
Yes. So we're going to come back all over again. So look at what's happening on the other side. And for us in India, I think we just feed into that, into that entire marketplace. So valuations apart, which I think it's already there. I mean, when I look at our portfolio under construct, out of the 20 odd names that we have, at least 5 or 6 of them are almost at price to book of 1. Okay, in my experience and my history that I've managed money, I've never seen 25% of my portfolio having a price to book of 1.
Okay. 25% of the portfolio.
25% of the names that are there are price to book of number 1. There are very few companies that have that exist in the Indian environment that have not gone through that stress test and have come back extremely profitably. So balance sheets have also cleaned up. India corporate is sitting at a historical low in leverage, historical low. So we've got data since 1999. 99 data goes back to say that corporate, the BSE 500 manufacturing or non-banking businesses were at a debt equity of 0.6. We're down to a debt equity of 0.5. Plus, we've got capacity at 75%. Now, this is a killer combination. I mean, you got capacity utilization at 75%, and you got all the capacity to leverage. You got operating leverage and you got financial leverage. So my sense is that you're not going to get stock in cheap in India, right? The only thing is that you got to wait it out for some time. You got to wait for the good news, and the good news is not very far away.
Let's get to one area which you really like. I'm talking about commodities, both soft commodities and hard commodities. It's a bit of an anti-consensus kind of view, more so on the hard commodities as compared to soft commodities. Explain why you like that space. What's the basic thesis?
This is the first time, I think, one of the very few times since India's independence, where virtually all crop prices are trading higher than MSPs.
Okay.
Okay. This is the first time that we've seen in history that you've got a large industrialization of agriculture. When I say industrialization, agriculture moving into industrial products, right? You've seen it through the ethanol policy. You will see it getting converted into plastic or single-use plastic over the course of the next year, 2 years or 3 years. So you've got a new use or new demand pattern emerging for agriculture, and that's kept that along with relatively weak or not favorable monsoons has kept supply reasonably tight.
Right.
Okay, right. New demand and supply tight, and that's created what we have today.
Right.
I don't ever think that commodity prices will ever be deflationary for a long period of time. One is you got a population growth.
And these are global commodities.
Yeah, global commodities I'm talking about. Once you got demand getting created from another stream of from another industry completely. Plus you got food consumption going up. Plus you have protein consumption actually moving higher, and all three of them are going to keep prices elevated. Now, when prices get elevated, I mean, let's look at it from a hard commodity standpoint. When say steel does well, the value chain works all the way down to iron ore and coke. So when agricultural commodity prices do well, what happens on the entire value chain? So there are elements of everything that is falling into place. Now we've been holding this since 2016, and the fundamentals of this argument tend to get a little better by every year. So I'm not too worried about it. Policy interventions always come through because at the end of the day, you will necessarily need to control pricing because of inflation. But if there is no supply, there is always going to be a challenge.
This position in the agriculture space you've been holding since 2016.
16 already.
And you're happy to continue to hold.
Well, valuations are fair. It's an industry which is consolidated. There is no second or there is no third manufacturer of any of these products out there, and even the converters are getting more consolidated than they have ever been before.
Sure. Hard commodities, you like steel, you like aluminum. Is that the way to metals?
Basically metals, yeah.
Many believe that the steel, that big move that we saw, I mean, we saw the best of it. It's perhaps behind us.
Yes.
You disagree?
Even if it's behind us, at current valuations, the cash flows are going to be very close to almost historical highs.
Okay.
So you strip out 2022 numbers, and you even go back to 2021. You will see a linear growth from 2021. 2022 was excesses that got built up, and cash flows were excesses. But 2023 over 2021, I don't think any investor or entrepreneur or company involved in commodities is going to be disappointed.